All right, guys, kind of an ugly day in the market today, and Disney just reported they beat on earnings. They missed on revenue. They were supposed to make 96 cents a share. They made $1.03 per share. They were supposed to report 22.5 billion in revenue. They reported 22.3 billion in revenue. Right now, after hours, they're pretty much even. Nothing crazy. In this video, guys, we have something for beginners. We have something for more advanced people. Mo is going to go through their actual earnings press release, talk about some very high-level things. We're going to go look at some high-level metrics of the company. We're going to do analyst estimates. We're going to look at our 8 pillars on Disney. And then we're going to finish it all off with the most important question that you're probably wondering. How much do I pay for Disney stock? We're going to use a stock analyzer tool to figure this out. So, guys, please stick around for the entire video. There's something here for everyone. Let's check out some high-level things. Mo.
Yes.
How big is this moat for Disney?
Pretty big.
Guys, Disney's market cap is 160 billion. That means if you bought all the shares available on the market at the current market price, it's been $160 billion. You ain't replacing Disney. Why do I keep saying Disney? Disney for $160 billion. And ESPN, which is one of their separate companies, just announced a deal with PENN Gaming, which actually ended up kicking out.
Not kicking out. Freeing.
Yeah, freeing
Barstool Sports.
David Portnoy. I heard he paid $0 for it.
$0. So the rough numbers, they paid $500 million for this back 3 years ago. So basically, they gave him $500 million, and
well, they didn't give him $5. They gave him a percentage of it.
So now he's got the company back. The caveats are he had to sign non-compete, and if you sell the company, you owe PENN Gaming 50% of the sale. But he said he's never selling. He said he's going to the grave with it. And if he dies, it's going to this person. If they die, it's going to this person.
I saw that video. Listen, it made sense. They said, listen, he can't be who he wants to be.
And honestly, I think it was a good move for PENN Gaming. They used Dave's likeness to put them on the map, and there you go.
Awesome. All right, some other things, guys. Net income in the last 12 months, not including this quarter, $4 billion. The average in the last 5 years was $4.6 billion, but that includes COVID. And I'm going to show you guys what Disney was making before COVID, because look at this. Their profit margin in the last year was 4.7%. The last 5 years, about 6%. All right. Now, let's go. I'm going to skip right to the income statement here, because this is what I want to show you guys. This is our income statement by 12-month marks. Look at this. Before COVID, they peaked at $78 billion in revenue. Literally, the month ending, the quarter ending when COVID started, $78 billion in revenue. They're now higher than that, $87 billion in revenue in the last 12 months. And look at their profit. This is the crazy part. $4 billion in the last 12 months. They did $13.5 billion in 2019. Some major numbers here, guys. They haven't made this low amount of money in a long, long time. Their profit margin was consistently, I mean, what is this? 13 billion on 60 billion? That's 20%.
Yeah, it's nowhere near that.
They're at 20, so they're not even close to that. So the question I would ask you is the play on Disney that they haven't even gotten back to their normal profit margin levels? And this is what I want you to understand as an investor. When you're looking at a company and you see this PE, and you look at this PE right now, the PE is 39, but is it misleading? Because their profit margin is 1/5, 75% lower than it was before COVID. So the question you need to ask yourself is, can they get back to pre-COVID profit margins? That is the major question.
You think they can?
Mo, I haven't done enough research on it, but if I were to bank on anything, I would say what's changed since COVID that makes it all of a sudden they can't make their profit margins back?
Yeah.
The parks is still the same business.
Right.
The cruises are coming back online. They're actually doing more streaming now, which is a higher margin business with their catalog of movies and shows.
Yeah, that's true.
Like, I'm looking at going, how can they not, even if they get back to half their, they just get back to half of their margin, to 10%. They're going to be making $8 or $9 billion a year. And would you pay 18, 20 times multiple for the moat that is Disney?
Yeah.
I think so.
Yeah.
That's what boggles my mind. Now, guys, I want you guys to see something else. Look at the all-time high. March 8th, 2021, $203 a share. That's over 2 years ago now. And look at it now, $86 a share. Hit a low of 84 back at the end of December. So guys, this might be an opportunity. This could be an opportunity that you look at. And if you truly believe that Disney will get back to 20% margin, let's look at it this way. On $88 billion in revenue, 20% margin is $17 billion. That'd be paying 9 times earnings today on Disney. Now, I'm not telling you to go do that. And full disclosure, by the way, guys, I own Disney stock. Mo, do you?
No.
Don't buy it just because I own it. I am fully comfortable with Disney stock falling in half and me buying more. It needs to fit your criteria. I don't think I'm buying Disney stock to make 15% a year. I'm buying Disney stock, in my opinion, to make lower than that, but a stable moat business that I can think of, I can own and not worry about quarter to quarter. So my goals are going to be a lot different than yours. Never, ever buy a stock because somebody on the internet tells you to, because I'm not telling you to. I'm just telling you, I'm trying to teach you a process that you can then apply to other investments out there. All right. So let's go to the 8 pillars here, and then we'll go to, oh my God, look at these 8 pillars. Now remember, if you have our software, guys, you can edit your pillars up to 12 different kind of pillars, 4 quadrillion versions. Guys, this is only a 1 green check mark company. Do you see this, Mo?
Yeah, it's wild. You would think that, I mean, I would hear in my head Disney, and I would think everything is lighting up except for the valuation metrics.
Everything is bad here.
You know?
Everything is bad here. Everything is bad here. It looks ugly. And if this were a company that was a $5 billion company, I'd be concerned right now going, okay, what are they doing? But this is Disney. And I think you got to give them a little bit more credit of turning things around. To me, it reminds me a lot of Southwest. You know, Southwest is at record revenue, but they're not getting the profit in that they used to get. So I'm looking at saying, okay, is there something? I think there's better explanation for Southwest. But I think it's very important to understand why their margins are so low and can they get back. Mm-hmm. All the more reason to go in our community and have a conversation about Disney with the people there.
So Disney Plus subscribers in US and Canada, so North America, has fallen.
1%?
Internationally has gone up. You know, I can look at these 2 ways. I can look and say, okay, they really they went to a really high number that they shouldn't have been at during COVID because people were staying home, and it's coming back. But I could also see it as, okay, that period is over. I would expect to see some growth at this point, but I don't know which one is right, which one is wrong, but I can see it both ways.
Like you said, before COVID, I think their goal was like 5 years away from getting 100 million subscribers, and they got it during COVID.
Yeah.
I have Disney Plus.
Do you?
Yeah, because I'm just like, it's like $6. I get ESPN. I get, or whatever it is, $10. I get ESPN. I get a bunch of
ESPN with that?
Yeah, because
I didn't know that.
I think well, there's some bundle.
Oh, okay.
I have like Hulu, ESPN, and Disney all together in a bundle.
Gotcha.
And I pay like $15 a month for, I don't know what I pay. But bottom line is, I joke with people and say, guys, I have like every streaming service out there and it's still cheaper than my cable was 10 years ago. So I don't really care. I just look at it as like, let me look and see what I haven't seen Paramount Plus in a while. Let me go see what's on there. Mm-hmm. That's the way I look at it. So with people out there who are like, I'm not going to waste the $7, I'll waste it. I don't care.
Look at their free cash flow increase from the last quarter of 2022, the second quarter of 2022.
Oh, wow. Almost 10x. Yeah, it was like 9 times more.
Big jump.
Look at greater than 100%.
Yeah, great. They're just like, yeah, we'll just stop there.
So guys, this is the actual press release Disney put out, and it allows us to go look at it completely void of all biases. Remember, they're going to have an earnings call at some point, right?
Probably
today,
probably
5 o'clock.
Yeah.
And they'll be explaining some things in more detail. If you want to go listen to the earnings call, do it because it's a good way to listen to what they're saying. Now, there's a lot of fights about their wokeness and all that stuff, and I'm not going to get political about that stuff quite yet, but I look at it saying it's a good way to get an understanding of what the company truly believes in. You know, Bob Iger is back. People love that. But at the end of the day, I'm going to look at it and say, hey, Bobby boy,
do you love that?
I want this high.
Because I've been thinking,
I don't know, your buddy upstairs, Mikey, loves Bob Iger. He
does love Bob Iger. And, you know, I was driving the other day. I had like a 40-minute drive, and I don't know why, but I was thinking about Bob Iger and Disney. And I was like, do I really love that? I don't think I do.
Listen, some people would argue, like, Paul, if you're not, like, hell-bent on the CEO, why do you have the company? Because it's not a $500 million company.
Yeah, I don't think
it's a $100 billion company, and I think they're probably going to do pretty well with whoever's manning the ship.
Now, my thought process of it was, do I want to own Disney because can they turn the margins around? That was the kind of the thought behind it. And I was like, is Bob Iger the right person for this job? Can I say something here?
If their margins went from 20% to like 16%, it'd be a lot harder. It'd be like, oh man, can they really get back to 20? They went from 20% to 5%.
Well, what if they only go to 10 now?
That's what I mean. But as I said to you before, if they just go to 10, you're still buying a high teens free cash flow multiple and earnings multiple for a great moat business.
Yeah.
That's the way I look at it. It's very simplistic. My goal is to be simplistic. That's why I don't look for $100 million companies, because I don't want to get in the weeds and worry about who's the CEO's, housekeeper's, uncle's best friend. I just want to sit there and say, all right, Disney's going to be around for a long time. Mo, you and I are more likely to die before Disney would die.
Mm-hmm.
And I look at that saying, okay, do I think Disney will make more money in the next 10 or 20 years than they're making today? Yes. Can I pay a reasonable price for it today? It seems expensive because it's 39 times earnings, but that margin's so beaten up. That's the big key here, the margin. Can they get that margin even close? If they can get to 12 or 13, 14%, that's huge numbers because they're already showing record revenue from before COVID.
Mm-hmm.
That's incredible.
Here's a little breakdown of their media and entertainment system, comparing it to the same quarter of last year. It's a little bit down 1%. Now, parks, experiences, products, that's up 13%. Total segments revenue up 4%, like we mentioned earlier. Those are just some of the little breakdowns. I'm going to keep scrolling here just to see what else we have.
So another benefit of our software here, Mo, look at this. EPS. They're expected to make $3.76 this year. $9.23 in 2027. So look at this, Mo. We've got huge growth levels in EPS, but look at the analysts' expectations for revenue growth. Not very high.
Yeah.
So they are expecting margins to turn around. That is something they're very much expecting. And because of that, that to me says, okay, even the analysts are saying, hey, maybe these margins are a little, kept down and they might explode a little bit.
Mm-hmm.
So if they can get back to $9 a share in profit in the next 4 years, apply a 20 multiple of that, you're doubling your money in 4 years because a 20 multiple of 9 is 180. It's currently at 88. You're going to over double your money? Maybe. This is a thought process that I have here. Am I right? I don't know. But if I had 30 situations like Disney where they're affected because of COVID and they're on the way back, I'd be making a lot of bets there. And that's the key here. The key here is to make these bets that make sense are rational. And the less work you want to do, the more diverse you have to be in your holdings. And that's the way I choose to be as well. Anything else, Mo?
I'm looking at their stock chart, and I'm really going back here to 2015. They really haven't, the stock price hasn't done anything outside of COVID since 2015. Actually, right now it's lower than that level.
Yeah, but you know what I think about stock prices.
Yeah. All right, let me continue on. Oh, so Hulu is down. Hulu Live TV. What's it called? Hulu
Live.
That's what
Is
it
it
is.
Live?
Hulu Live.
That's what I just go to.
Down 2%. Total Hulu though is flat. So really no growth on the Hulu end in the quarter.
I have Hulu. I like it.
Do you?
Except when people text me during a game and I have a 30-second delay and I see I missed the game-winning touchdown because somebody said, "Oh, we won." I'm like, "Wait, what?"
ESPN Plus is down 3%.
What was that? That's true. I did put everybody in Do Not Disturb on my texting. That is true.
Here's Parks. Okay, Parks up 4%. International, holy crap, up 94%.
Yeah. Consumer products down. Supplemental operating income. Oh, wow. Look at that.
Yeah.
These are good numbers.
They are.
These are good. These are showing that we're getting back. So $1 per share.
Better.
$1 per share is how much? They currently have they're basically calling it like 1.9 billion in profit times 4. If they have 4 quarters of the same thing, you're talking about high sevens, $8 a share almost in profit per year. No, not correct. Oh yeah, there you go. $8 billion in profit. $8 billion in profit. I'm sorry. Okay.
It's getting better.
Yeah, it's getting better. Now, guys,
price is barely down.
This is where we bring in the stock analyzer tool, because I said to you at the very beginning, you're probably here thinking to yourself, what price do I pay? And this entire software here was built specifically to help people understand investing and understand what price to pay based on their assumptions, because everybody's gonna have different assumptions. On Twitter, I put up something about NVIDIA and said, what assumptions you're giving? And I just got the wide range of assumptions. I put my assumptions about Apple on Twitter. I got people saying, you're crazy low, you're crazy high. The point is, it's about you and making your decisions. So if you like the software, if you like what you see, all the software, all the tools that are up here on tools, There's 7 or 8 tools here that are absolutely amazing. It's getting better every month. Go to everythingmoney.com. It's about $1 a day. Go sign up. It'll change the way you do money for $1 a day. Go check it out. So let's do our stock analyzer tool. 10 years, Mo. Why don't you give me some, what's it called?
Numbers.
Yes.
4, 7, and 10.
Okay. 4, 7, and 10 for 10 years. That's a lot, Mo.
I know.
Because remember, the analysts are expecting like mid-single digits.
I know, but they are going into more high margin areas.
Well, that wouldn't be revenue growth. That'd be profit margin growth.
Oh, I don't know. Continue.
Okay.
4, 7, 10. I just changed my profit margin.
Okay. What's your profit margin?
So I did 6, 12, and 18.
Okay. I like that.
Previously, it was 6, 10, and 14.
Okay.
So I just moved it up. I did the same for free cash flow margin.
Okay. Because over long periods of time, free cash flow and profit should be the same.
Yeah.
Now for PE. Now this is a company, guys. We believe for PE that you should start at 15 and then go higher based on more revenue growth, more profit growth potential, and a moat, and go lower for the exact opposite. And I think this company has a lot more potential, but the moat is the big factor here. So Mo, what PEs are you putting in here?
I did 17, 20, and 23.
Wowzer. Okay.
I mean,
and same thing with free cash flow, right?
Yeah, it's a moat.
It is a moat.
So,
and let's remember, Coca-Cola, Warren Buffett paid 30 times in his first purchase of Coke. He bought it for 30 times PE. Now, finally, for desired return, guys, this is your margin of safety. This is where you start and sit there and say, I can get 9 or 10% from buying a long-term ETF. So what return do I want for buying an individual stock? As you make a higher assumption, you need a higher margin of safety. So therefore, a higher return you should get for those high assumptions because they're less likely to occur. So Mo, give it to me.
I did 10, 13, and 16.
Man, I like that.
Yeah.
I do like that. So I'm going to hit the analyze button. Now remember, guys, I'm going to go through some numbers here, stay through the entire video. It's only about a minute left. You can stick with me here, listen to our explanation of the numbers, and remember, this software is ready for you at everythingmoney.com. Boom. A low price of 47, a high price of 175, a middle price of 105. Guys, current price is 86. If you pay the current price and Mo's low assumptions occur, you're going to make about 2% a year over the next 10 years. If you pay today's price, the middle assumptions occur, you're going to make about 16%, and high assumptions occur about 27%. So it's a wide range because there's a lot of unknowns here and their profit margins are subdued. So guys, again, everythingmoney.com, go check it out. We appreciate your time very much.